Appreciate it.
Yeah, but don't worry about any of the risk information except the rate class. Just keep it standard non-tobacco. Don't worry about table rating. Don't worry about flat extra, pension underwriting, none of that. Owner type. This is you're only going to mess with this if the owner's actually different. Like, is there going to be a different owner? This is going to be important when you're writing like a children's policy or for someone, let's say they don't qualify for the IUL, but it still makes sense for them to have an IUL in someone else's name. This is going to be where you put the owner type. It could either be an LLC owns the policy, a trust can own the policy, or a different individual can own the policy. So that's where you'll mess with that. You go straight to death benefit and funding. What a 45-year-old up here? Yeah,
Yeah.
45. Okay. Mech avoidance, yes, adjust phase, keep guideline premium test. I do minimum death benefit max cash value almost every single time. Sometimes I do balance, but that's only if I want to give them a larger mech premium so they can fund it more aggressively in the future. But I never really pitch IULs for, I'll never really pitch MLG IUL for death benefit. If I'm gonna get someone a specific death benefit, I'll get them like IULE if I need to. Uh, he's 45, so I'll do increasing death benefit till age 65. Then it'll change into a level death benefit. So that death benefit is going to turn into, it's not going to increase anymore. It's going to stay level. The cost of insurance is not going to increase on him. And it's increasing right now, it's going to start off a little bit lower. So the cost of insurance is going to start off lower for him right now. That means he can grow more cash value quicker in the first 20 years because that cost of insurance is not going to eat him up so quick.
What is that one that M stand for? Is that one first year to maturity?
Yes. So I'll do premium mode. Don't worry about the first year lump sum. Don't worry about that. Don't worry about the maximum face amount reduction. Monthly target premium, specify amount, say 500 a month. Yeah, M is just maturity of the policy until they die. I just do one through age 65. 1035 exchange, don't worry about that. Distribution, don't worry about that. Loan repayment, don't worry about that. Solve, don't worry about any of that. Riders, I do like to add waiver premium on here, maximum benefit. This is if they do get disabled, the insurance company will pay that $500 a month for them every single month. Interest rates is automatically calculated at US Pay Setter, so we don't got to really fuck with it. Keep it US Pay Setter. And then there's Quick View. And now he has a sick policy. So neck premiums 11.3 thousand, meaning the maximum he can put in on a yearly basis is 11.3 thousand dollars. Because if he put in more than that, it would be considered a modified endowment contract. That is just where he loses the tax advantages of a life insurance policy. Now it's more considered of an investment. So he
Does that
loses that tax-free benefit. What was that, Lux?
does that reset like every year? So like
Yeah,
okay, okay, gotcha.
yeah. Every year you can put in up to that much. The minimum premium is essentially the cost of insurance. That's like, all right, that's the minimum we have to put in a year to keep the policy alive. So out of that 6,000, around $4,200 is going towards the accumulated value, right? During the first 10 years, there is a surrender charge to where if he actually just uh, takes a loan from the policy or just physically withdraws, there is a certain amount of money the insurance company keeps, which it's like $3,000 or so. And it gets smaller from year 5 to 10. During the first 5 years, it looks like it's around $3,000 for this guy. Right? Most policies, they're going to break even around year 5 to 10. So let's say he put $60,000 into the policy. He's still not at break even. He wouldn't hit break even until, let's say, that's 72,000 here. Till year 12, this guy wouldn't hit break even based off 6.4% interest. So that's why when people are like, hey, can I just put this in for like 5, 10 years and then just withdraw all of it? Yeah, you could, but that'd be fucking retarded. There's no point in doing that. Like this is a long-term policy. We want to have this for the rest of
Figure,
our life.
figure.
What is good, Isaac?
All right, so on year 12, so surrender charge, if you were to take anything out, it would reset to zero.
No, so the surrender charge is only from year 1 to 10, and that's just the difference between surrender value and the
Oh,
accumulated value. So this is like if he takes a loan out from his policy in the first 10 years, it's from the surrender value. And the surrender value is a little bit less than the accumulated value because if he
oh,
takes a
okay.
loan out from the full accumulated value in the first few years and he fucks some money up, then he has no more cash value in the policy, and then like that could fuck him up long term. And then it just kind of
Okay.
ruins his policy. It does protect him from messing up his policy early on too. So it's not a bad thing really. So that's
Alrighty.
the way I
Thank you.
explain it to people. Like I'm like, yeah, so you can see in the first 10 years here, there is a surrender charge. So that just means like if you do take a loan out from the policy, it's from the surrender value, not the accumulated value in the first 10 years. Which I mean, you take a loan out from the surrender value the whole time. The accumulated value is really how much money you have grown in the policy. The surrender value is how much you have access to. So if you take a loan out for let's say year 15 right here, year 15, let's highlight it. You took a loan out for let's say $40,000, right? Your accumulated value wouldn't change. It still grows at that 101,000. But this would turn to $61,000, the surrender value. You only have 61,000 remaining surrender, right? So that's the difference between surrender and accumulated value. And in the first 10 years, that there's a difference between the surrender and the accumulated to protect them from overloaning the policy.
Okay, that makes I was just affiliating surrender value to surrender charge. So I was just a little confused, but that makes sense. Thank you for explaining that.
No, you're all good, bro. It's a good question.
So after the 10 years, the accumulated value is what they have access to the pool.
Uh,
Did I explain?
yes,
Did I understand
exactly,
that right?
yes. But then once they take a loan out from it, I mean, the surrender value is always what they have access to. The accumulated value is how much they have in the policy that's growing at, but the surrender value is what they have access to. So even in year 5 right here, let's say they do 10% that year, that 10% is based off this 23,000, not the 21,000. So they're always getting accredited based off the accumulated value. What
Gotcha.
they have access to is the surrender value.
Another question I have is, say at year 12 they take some out. Do you have to wait another 10 years for it to break even again?
No, because unless you like actually physically withdraw, then maybe, but you still took money out of the policy, so not really. No, like that's really like the break even point is really like just based off, all right, I funded it with 72,000. Now my accumulated value is worth 72,000, even after the cost of insurance throughout the years. But that's the reason it's not the same because they have this cost of insurance coming out every year. But does that make sense, guys?
I'm with you. Yeah, that makes
Yeah.
sense.
Okay.
Yo, Gersh, on the e-app, I was writing up like these grandchildren, and the e-app's like really, really confusing on this one part. I remember it says like family coverage. It's on one part of the e-app, and it's saying
Yeah.
like, is the family or like is this do you have any siblings? And it's like, yes. Okay, are they insurable? Yes. And then it's saying like how much coverage do they have? Like assuming they have a policy or something. I'm like,
So
what the
that's
hell?
because there is laws saying that siblings do need to be somewhat equally insured. So when you're writing a policy, you can't just put $1 million on one kid and then the rest have no coverage. Like there is laws and rules that they do need to be somewhat equally insured.
Okay.
So that's why they do that. Also, the parents need to be somewhat equally insured as well, at least with something.
Okay.
So if you're gonna write a big policy on one kid, at least put a little something on the other kids too.
Right. So what I was doing is that it was going to be like 50 to $100 for like these four grandchildren. And but the grandchildren have not had a policy yet, so do I just say they would all have the same coverage amount? Because like
Yeah,
is that what would I do?
probably. Yeah.
Okay. Okay. Because it was like really
Yeah.
confusing on that part because I've
Yeah.
noticed.
No, that's always like worst case scenario for something like that. You can call the NLG customer or the agent services in like the
Yeah.
sales department or the just the regular agent service. and ask them like, hey, like what's the specific rules on this? And like they should be able to tell you that. Or just like use ChatGPT, be like, hey, like what it's the maximum or like what's the minimum amount of insurance I need in all siblings? Like what's the rule stating this and that? Like ChatGPT is an awesome tool. I use the shit out of it.
Yeah. Okay, fire, fire. I also saw this one thing. Like when you obviously there's a difference between borrowing against and withdrawing.
Hmm.
Is it taxable when you withdraw if you withdraw an amount that's less than the amount that you've paid into the policy so far? And then that money that you took out would get taken off from the death benefit? Is that how that works?
It doesn't, nothing ever gets taken out of the death benefit. It just comes out of the surrender value. But it is taxable. There's no income tax, but there'd be capital gains tax if necessary.
Okay. But they're only allowed to take out um like a less like it has to be less than what they've already paid into the policy. Like that's what they're allowed to withdraw from.
They can put money, I mean, they can, let's say they put in $100,000 total over the course of their life and their policy's now worth 500,000. They could take a loan out for 250,000 easily, and that shouldn't
Right.
be a big deal.
Okay.
But
Yeah.
the capital gains tax is a little bit tricky because it might be applied to the money they just put into it that hasn't really grown, but like the money has grown every single year, so there is somewhat of a capital gains tax, so that would be applied.
Okay.
And it'd be mostly long-term capital gains tax, which is smaller than short-term. Anything over a year is considered long-term capital gains tax.
All right, cool, cool. Appreciate it.
Yeah, but yeah, anything they just borrow from is completely tax-free.
Thank you.
I bet Jack. How long did you NLG to come through? When I first got contracted with NLG, I think it took like a month, probably like a month. And then Isaac, do we have to do the trainings that Kayleen sends you a link to? Yes, you do have to do those. Right. Does NLG have critical, chronic, and terminal benefits? Victor, it's a good freaking question, bro. Because they absolutely do. And they actually have critical, chronic, terminal illness, but they also have critical injury too. And they have Alzheimer's benefits as well. So they actually have the most living benefits out of the companies we work with.
That's insane.
And they have some really, really good riders. So that's a big reason why I actually really advocate for NLG. I think the biggest downside with NLG is just the fact that their commission is kind of ass for like small policies because let's say you have a 80% contract with FFL. Usually NLG is 30% less than whatever your FFL contract is. So if you're at 80%, that you're at 50 with NLG. If you're at 70, you're at 40 with NLG. So it's always 30% lower than your FFL contract, which, it is what it is because you're writing them an awesome policy. But you do have to take that into consideration, right? You might do a $4,800 AP policy, and the contract or the target premium might be $2,000, and then out of that, let's say you're at 70%, so 40% is what you're getting paid off of that 75% fronted. So you'll maybe make like $500, $700 up front, and then another couple $100 at the end of the year. So like nothing crazy, but you got to think about it like this. Now, if you're writing policies 5 figures, 6 figures, 7 figures, AP, shit, that's a good chunk of change. Like someone hands me $20,000, I'm gonna take it. Here's what it is. So, the way I structure them, like when I minimize the death benefit, maximize cash value, that does lower my commission. And I tell the client that they actually appreciate when you say that. So I always let them know it's like, yeah, the way I structure it, by the way, is I'm going to lose a little bit of money doing this because it hurts my commission, but I'm putting you in the best position possible, which I know is the best thing to do. So that's why I always do that for all of my clients. Like, does that make sense? Awesome. So like, I'll show them difference too. If I'm on FaceTime or Zoom with them, I'll show them the difference between level and increasing, or I'll show them the difference between minimized death benefit, balanced death benefit, and I'll be like, yeah, it's like you see this number right here, like that's a lot lower. Yeah, like the cost of insurance is, yeah, listen, I'll show them the target premium. Like, yeah, my commission is kind of based off this number, and the higher it is, the more I get paid. The lower, but I actually look to lower the whatever, like I look to lower my commission and increase your pockets because I'm putting them in a really good position. Now, if I'm doing that for 5-figure, 6-figure policies, I'm making a lot of money doing that, and I'm still putting them in a good position. So it's a good way to like get into that mode where it's like, all right, I might sacrifice a little bit right now, but if I get really good at these policies, I can start talking to people with a lot of money. And the people with a lot of money, you get paid a lot more, obviously. Rich people pay better. Just back to the matter. But yeah, that's really all I have. I'm gonna start learning more product knowledge, but would you recommend video ads stating I'm an IUL specialist, describing the product and how to qualify? Have you tried IUL video ads if you speaking? I have. I haven't really put a lot of money into marketing though, so I haven't really boosted them on Instagram much. I'm about to start doing that a little bit more here, so I think it's good. Make videos about it, talk to people about it. I mean, put yourself out there. It's absolutely phenomenal idea. Knockouts for NLG or what is riding the line of approval? Okay, that's actually a good question, Wyatt. So, knockouts for NLG, they are super strict. I think we do have an IUL knockout guide for them, but uh I mean, it's the same as like really any IUL, right? They're taking more than 3 or 4 prescriptions, probably not going to get approved. Felony past 10 years, not approved. DUI past 5 years, not approved. Felony, again, not approved. Uh, Suspended driver's license past 2 years, not approved. Um, Fuck, they owe child support, not approved.
How about like asthma, diabetes?
Asthma should be good. Diabetes, I believe, is most of the time good uh unless they're taking the one that you inject and the pill, then usually that's a knockout because they're like, yeah, he's pretty fucked up. But I've only had a decline with diabetes one time, but he had a bunch of other fucked up reasons too. So it wasn't just the diabetes. Like I've never had anyone get denied for strictly diabetes alone.
And then if someone's was a veteran and went only to the veteran hospital, whatever it is, for treatment, those records are sealed, correct?
They should be encrypted, yeah.
Okay, because this one guy has like nothing wrong with him, but like a spinal fusion that he got through the VA after 20 years of service.
He should be good then. I wouldn't worry about it. But yeah, if that's it, guys, I appreciate you hopping on. It's been a good hour. I love doing these calls. I love the product. Again, sell IULs to fucking anybody that qualifies. They're awesome products, and you'll make more money doing it long term. So,
One more thing, Gersh.
yeah, man.
Where would you recommend? I mean, I'm starting to learn from IUL. Just all these news collectively have helped out my team and I just learn more about IULs. We base off more on mortgage protection and final expense. But in the beginning stage, what kind of resources should I use to learn about IULs in my own time?
Zach Twardowski has good YouTube videos.
Okay.
Jake Wambo, Wambaugh, Wambo has good YouTube videos. Um, if you look up three-dimensional wealth, he has really good YouTube videos. That's Doug Andrew.
Yeah, Doug Andrews fire.
Yeah, he has some absolute bangers on YouTube. He's always consistently dropping them too, so that's really, really good.
Okay.
They actually host like a 3-day IUL like seminar every so often. Look to sign up for that. That's really good. But yeah, look up Doug Andrews, Zach Twardowski, Jake Wambo, all leaders in the IUL space.
All right. Thank you very much, Chris.
Yes, sir. I appreciate you guys. Let me know if you need anything. The Zoom ID is one of my phone numbers. So text me your name if you have any questions. But yeah, I appreciate you all hopping on. Let's get after it. Let's have a big fucking week.
Appreciate you, Gersh.
Do it. Thank you, brother.
Appreciate y'all. Have a good one.
You too, brother.